Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's midday, Thursday, May 7th, 2015, and the title of today's audio blog is Tectonic Market Changes Portend Disaster. Now, I'd like to start this week's audio blog with something I touched upon yesterday, which is just how difficult it is to keep up with a global financial and economic environment, much less geopolitical and social, with so many moving parts, both real and artificial. It is literally a 24/7 job, as nearly every time I sit at my computer, be it early in the morning, late in the evening, weekday or weekend, I scan the internet for incremental data, consider it, and put whatever material is relevant in my notes file. My goal has always been to be the best I can be, and my work ethic will not allow anything less. And given that hard times drive me to work still harder, it has gotten to the point that I haven't taken a vacation day in more than 2 years, starting, not uncoincidentally, after the alternative currencies destruction attacks of April 12th to 15th, 2013, one day after Obama had a closed-door meeting with the so-called too big to fail bank CEOs. After that fateful day, the maniacal precious metal suppression that has dogged my existence since May 2002 has exponentially increased, as has the manipulation of every imaginable market from stocks to bonds, currencies, and commodities. Heck, even when I was in China adopting my beautiful Sylvie in July 2013, I was up in my hotel every night at 3 a.m., Diana and Sylvia sleep right next to me, typing articles to help readers understand the complex financial world around us, which sadly barely a handful of people both understand and care to share. And then, of course, there's my personal survival instinct, as having finally climbed the totem pole to what I view as the best imaginable job, the cartel is doing everything in its power to sabotage it. Fortunately, the endgame for precious metals is set in stone, and equally fortunately, Miles Franklin is one of the strongest companies in the bullion business, not just financially, but morally, featuring not only competitive prices and unparalleled customer service, the industry's finest storage program, the best educational blog in our sector, free of charge to all, but a management team that truly cares about its clients. Not to mention one that practices what it preaches, in holding significant percentages of their personal assets in precious metals, much of it held in the company's own storage program at Brinks in Montreal. Anyhow, the reason for this commentary, mirroring last week's article, Truth and Passion at a Premium, is because we at the Miles Franklin blog, as well as countless peers in the global truth-seeking community, are fighting harder than ever to keep up with the utterly explosive growth in money printing, market manipulation, and propaganda. All three serve to ultimately make the horrifying end game we know is coming that much worse. But in the near term, it is extremely difficult to fight against. For the reasons cited above, I feel a great burden on my shoulders to consistently, unwaveringly provide a voice of reason amidst the relentless cacophony of financial babble emanating everywhere from the people's worst enemies, i.e. governments, bankers, and the mainstream media, to its supposed best friends, like wolf in sheep's clothing newsletter writers that will say and do anything to take your money. From a personal standpoint, perhaps the most difficult thing I've had to endure is the fact that the vocation I diligently pursued for nearly 2 decades, from my first internship at Payne Webber in 1989 to my last day as an equity analyst at Solomon Smith Barney in 2005, has been destroyed by the algorithms, derivatives, and other financial weapons of mass destruction that have commandeered markets, and likely permanently destroyed the price-seeking role that freely traded markets in functioning capitalistic societies have been providing for centuries. Fortunately, such weapons can only temporarily staunch economic law in physical markets like gold, silver, oil, copper, and other real items of value, as opposed to paper markets where intrinsically worthless pieces of paper can be conjured up at will. This is why I view the odds of stock market hyperinflation as no lower than those of collapse, whilst in the aforementioned physical markets, fundamentals must inevitably prevail, not just nominally, but in real terms. Frankly, I don't have a particularly strong view of what the long-term real value of copper and oil will be, or even the intermediate term for that matter. However, given the lessons of 5,000 years of history and the fact that today's fiat Ponzi schemes are the largest in history, I have not a shred of doubt of what direction gold and silver's real values will be going, hopefully in the short term, but if not significantly past it. Simply fundamental analysis, as opaque as the powers that be try to make it, shows us that global demand is at or near all-time high levels as we speak, whilst gold and silver supply, which have only marginally risen through the 12-year bull market, has clearly peaked, with a strong likelihood of utterly collapsing in the coming years. This is particularly true in the case of gold, where miners are starting to report significant year-over-year production declines, whilst in silver, production has flattened but not yet fallen. However, with cartel-suppressed prices having been below the cost of production for several years now, mining balance sheets are in severely weakened states, with capital availability at a multi-decade low. Capital spending has been dramatically slashed, major developments delayed or shuttered, and oh yeah, essentially zero major discoveries have been made in more than a decade. Which, I might add, is as much a consequence of the dramatic depletion of the naturally occurring metal as the soaring costs of finding and producing it. Trust me, I know this well, as between 2002 and 2008, I held 100% of my net worth in mining shares, and from 2008 to 2011, a still significant portion. Not only that, I spent 2006 through 2010 working for literally dozens of mining companies, either as a corporate development officer, investor relations officer, or investor relations consultant. In that time, I traveled the world visiting mines, meeting investment bankers, and attending mining conferences. Based on this extremely stressful experience, which I might add, included dollar price gold and silver ultimately reaching $1,920 per ounce and $50 per ounce respectively, I sold my last mining stock in the summer of 2011, having finally realized that the risk-reward ratio relative to physical metal was too great, and that given the rapidly deteriorating state of the global economy, heightened activity of the gold cartel, and likely draconian government actions as the inevitable end game plays out, it was highly unlikely that mining stocks would ever become the internet stocks I once envisioned. And the same goes for closed-end funds like the Central Fund of Canada, which in February 2013 I correctly predicted would be driven to valuations well below net asset value, as the cartel would naked short them into oblivion to prevent what Eric Sprott accomplished in late 2010 from repeating, when he took his PSLV Silver Trust public and nearly drove the already tight physical market through its 1980 highs on the heels of a mere $575 million offering. To that end, I hope and pray that the great Admiral Sprott's current attempt to consolidate his Fizz and PSLV Gold and Silver Trusts with the Spicers family's GTU and SBT versions will enable the combined valuations to push above net asset value, and thus enable new offerings to buy physical metal. However, since the bids were announced for the trusts, all the valuations have done is increased from roughly 9 to 10% discounts to net asset value to 6 to 7%. Well, I have lots to cover today, and geez, I've already written 2 pages without getting to them. However, I'm going to stay on topic by reminding listeners just how dire the precious metal production outlook has become, amidst the aforementioned record level of global demand, particularly in the Eastern Hemisphere, which promises to continue rising until the current global fiat currency regime inevitably collapses. To that end, I have for years discussed the aforementioned topics of how precious metal miners' opportunities to increase production were vanishing, as well as the ability to finance even the simplest of expansionary activities. To that end, I looked forward to the industry's year-end results, which as I expected were utterly horrifying. Consequently, my February 20th article was titled "Initial Mining Earnings Essentially Confirm Peak Gold." And after viewing the majority of first quarter earnings this past month, I have never been more positive of this outcome. Or for that matter, that if by year-end the cartel hasn't been significantly backed up by a material price surge, I'm quite confident that more than 95% of the exploration sector will be bankrupt, as well as a third to a half of small-scale producers and even some of the world's largest mining companies. Thus far, my predictions in this morbid arena have been spot on, and watching the stock price action and balance sheet deterioration in the mining sector in recent quarters, I couldn't be more certain of this outcome today. To wit, as I discussed earlier this week, the world's 10th largest silver miner, Coeur d'Alene, saw its net debt to equity ratio skyrocket from 34% to 60% in the first quarter alone, whilst Kinross, I believe the fifth or sixth largest producer, reported a 5% year-over-year gold price decline. Moreover, as predicted in my February 2013 article, The Rise and Fall of South African Mining, the high-cost South African miners would be the first to go if gold prices were suppressed to the levels witnessed today. To that end, look at the stock of Gold Fields, the world's seventh largest gold producer, whose CEO, by the way, in June 2013 espoused, quote, "The industry is not sustainable at $1,230 an ounce. We're going to need at least $1,500 an ounce to sustain this industry in any reasonable form." Following an utterly atrocious earnings report last night, featuring significant losses and a 10% year-over-year gold production decline, GFI stock plunged 12% to a new all-time low, following a 9% decline yesterday, as clearly someone knew what was coming. On average, the big three South African miners, AngloGold, Harmony, and Gold Fields, which cumulatively produce 8% of the world's gold, have seen their stock prices fall by an average of 87% since 2006, which I might add, for those that believe weak currencies are good for business, is when the South African rand peaked. As for the rest of the beleaguered mining industry, look no further than Barrick Gold, which too dramatically missed its production guidance in the first quarter, to realize just how dire the global gold production outlook has become. Barrick, or as I described them in a 2013 article, evil personified, has seen its net debt to capitalization balloon to nearly 50%, and thus has made it its primary goal this year to reduce debt. At the expense of future production, of course, which is already expected, before additional divestitures, to plunge from 7.4 million ounces in 2013, or 9% of global production, to as low as 4 million ounces by 2022. Given that they last year appointed a former Goldman Sachs CEO as chairman, who promptly awarded himself a $13 million bonus for overseeing massive losses, debt accumulation, and stock price declines, as well as former U.S. House Speaker Newt Gingrich and former Canadian Foreign Affairs Minister John Baird to its International Advisory Board this year, it couldn't be more obvious that their long on and off merger discussions with Newmont Mining are likely front burner topics anew. And trust me, if and when they merge, the dramatic capital spending declines announced already will pale in comparison to what's coming, which again will only further accelerate the decline in global gold production, given that Barrick and Newmont are the world's two largest gold miners. Afterwards, I expect the entire dying industry to follow suit, maniacally consolidating in a survival play not much different than what I experienced firsthand as an oil analyst in 1999 to 2000, when a temporary oil price decline, in spite of a cartel seeking to support prices, caused the most dramatic merger wave of the 20th century. Read ExxonMobil, BP Amoco Arco, Chevron Texaco, ConocoPhillips, Total Fina Elf, etc., and an equally dramatic round of multi-year production and spending cuts. Okay, on to today's next horrible headline, which, given the high likelihood of a default next week, on the 12th to be precise, when Greece owes the IMF 770 million euros it decidedly does not have, I would normally be talking about the ongoing Greek tragedy. However, as there's only so much I can say on the topic, I'm going to let it lie this week and let the chips fall as they may. The fact that global interest rates are surging in terrifying fashion, which I'll get to momentarily, is not being attributed to the mainstream media to Greece's dire financial situation in any way. And perhaps there's no connection at all, as perhaps the rest of the world is aware of a viable solution to the 400 billion euros of debt Greece owes, and mathematically must default on unless it is monetized via the ECB's printing press, perhaps in the very, very near term. This crazy situation, or better put, deformation, which 3 years ago nearly destroyed the European Union, when Greece had half the debt but 4 times the interest rate, is somehow being glossed over as if somehow all will be well, when in reality said hyperinflation is quite obviously the only viable option. And since the so-called Troika claims there is no way they will give Greece another penny without the mythical reforms that have not even been defined, let alone considered, I'm not sure why there remains a single person on the planet that doesn't realize a large-scale default is coming, and coming soon. And when it does, the same will occur in the rest of the pigs, France, and countless other nations burdened with what their leaders deem, quote, odious debt, i.e., quote, debt incurred for purposes that do not serve the best interests of the nation, and thus should not be enforceable by international law. But enough on that boring topic, as obviously the ECB can simply print all the euros it wants to buy up the Greek debt, and in doing so, avoid all negative ramifications. Okay, on to the global economy, which is deteriorating more rapidly than at any time in the modern era, including, by the way, 2008. Frankly, the only difference between then and today, aside from much higher debt, unemployment, and inflation, are the financial bubbles serving to mask the carnage, as inflated by the most maniacal monetary easing schemes in history, i.e. the ZERP, NERP, and QE initiatives currently being undertaken by essentially all global central banks, no matter how obvious their path of political, economic, and social destruction has become. Except for the 1%, of course, that directly receives these subsidies, which is why, for example, the mainstream global retail industry is in shambles, with 6,000 stores expected to be closed in 2015 alone. But luxury brands like Porsche and Maserati are seeing explosive all-time high sales. Or why the average American's home hasn't budged following 7 years of record low mortgage rates, but high-end properties in New York, San Francisco, and South Beach have skyrocketed. No, the average American, according to the Fed, is experiencing deflation, certainly in the realm of home equity. But as described in this week's article, Deflation and the Soaring Cost of Living, decidedly not in the realm of need versus want items like food, insurance, tuition, and day-to-day services. And to Janet Yellen, who in December deemed low oil prices a, quote, net positive for the economy, I'd first like to ask how said price decline translated into 3 months of declining retail sales in a row. In fact, the first 3-month sequence of declining retail sales since 2008. And second, what will the economic effect be of the recent surge in gasoline prices from roughly $1.80 per gallon in January to $2.50 a gallon today? As for the U.S., and by the way, every single time gas prices have had a surge of that magnitude in U.S. history, we've rapidly gone into recession, which, by the way, we've never left. As for the U.S. economy as a whole, it has, since last fall's Obamacare and inventory bill-driven GDP gains, officially declined more rapidly than at any time in the nation's history. And that includes 2008, whose absolute lows were barely below today's levels. Across the board, economic data has been in free fall, particularly real data like retail sales, durable goods, factory orders, construction activity, and personal spending. Even Island of Lies data like biased, statistically insignificant diffusion indices have been falling, and heck, even the March NFP employment report, i.e. the most upwardly rigged, albeit painfully transparent, economic report on the planet, was an abject disaster. As was Wednesday's ADP employment report and labor productivity report. Monday's catastrophic trade deficit representing the largest such deficit explosion in the nation's history. And today's Challenger job cut report representing the largest monthly surge since the 2011 mini crisis. You know, when stocks plunged, the U.S. was stripped of its AAA credit rating, and dollar price gold hit an all-time high. But have no fear, as the most useless report of all, weekly jobless claims hit a 17-year low this week, which, as you can imagine, is no consolidation to the tens of millions that have given up trying to find a good job, which is probably why the labor participation rate sits at a 37-year low and real median income a 4+ decade low. And thus, as we prepare for tomorrow's April NFP report, which, as you can imagine, the powers that be are hotly debating as to how hot or cold they want it to be, we can't emphasize enough that we have said all along, i.e. anything even remotely, quote, positive about the report is a lie, which irrespective will be not only easily refuted, but more than offset by the horrific report internals, if only you take the time to read them. Or alternatively, to read what the Miles Franklin blog has to say about them, which I promise we will. Which brings me to today's principal topic, i.e. the tectonic market shifts occurring as we speak, as well as the disastrous future they portend. To that end, it was just a few weeks back when the only noticeable trend change in the world's hideously manipulated markets was the blatant action of what I opined to be the newly formed oil PPT, Clearly a U.S.-led operation to stave off the bankruptcy of hundreds of high-cost, massively leveraged shale producers, which, by the way, have not only accounted for essentially all of America's pathetic GDP growth since the 2008 crisis, but all the incremental jobs as well, including, as you can imagine, nearly all the high-paying jobs. However, in the past 2 weeks, the inexorable rise of oil prices, contrary to the conclusion of every imaginable aspect of traditional fundamental analysis, has been joined by several other gargantuan market anomalies, which in sum total depict a significant weakening of the power that be's seemingly ironclad grip over markets, which, if it cannot be controlled soon, will likely cause the long-awaited inevitable big one to commence in short order, which, if it does, will destroy the real values of history's largest ever financial asset bubble, the world round, either by 2008-style crash or Weimar-like hyperinflation. Back to the strange price action of WTI oil, which has risen from $42 per barrel in mid-March to nearly $63 per barrel yesterday, amidst record off-the-charts inventory increases, weakening global economic activity, and a massive inventory of drilled but as yet uncompleted wells. Not to mention expectations of significant Iraqi production growth and an oddly timed Iranian peace agreement that could lead to an additional 1.5 million barrels per day, hitting the market in a reasonably short time frame, atop a market already oversupplied by 1 million barrels per day. Clearly, oil prices in the 40s, let alone the lower levels the aforementioned fundamentals suggest, would catalyze an economic and financial crisis on a par with the subprime mortgage debacle of 2008. And thus, it's difficult to believe a newly formed cartel of sort, i.e. a covert paper-only version of OPEC, is not working behind the scenes, just as the covert gold cartel maniacally suppresses gold and silver prices amidst the aforementioned wildly bullish supply and demand outlook. And then there's Dr. Copper, the widely recognized king of industrial commodities, which has seen its price surge despite a doubling of LME inventories in the past year, multi-decade weakness in global fabrication demand, and telling, damning, massive weakness in other industrially sensitive commodities like coal, iron ore, and steel. This one is as mysterious to me as the oil price surge, albeit equally important from a perceptual standpoint. And finally, there's the potentially earth-shattering surge in interest rates we've seen in the past 2 weeks, from Japan to Europe to the United States. Seemingly uncatalyzed, and certainly not due to expectations of surging economic activity, given the across-the-board near-record weakness from the world's four corners. The surge in sovereign bond yields took nearly everyone by surprise, including me, I might add. Although in my defense, I have long claimed that sovereign yields would collapse to record lows as the world's financial community front-ran central bank QE to infinity, which they certainly have, until, that is, hyperinflation fears inevitably arise when money printing and the associated massive debt accumulation pass the so-called tipping point of believability. That said, it was quite shocking to see many European bond yields rise above the levels from when QE was announced earlier this year, including the German 10-year Bund, which incredibly rose from an all-time low of 0.05% just 2 weeks ago to a high of 0.76% this morning. Here in the States, the 10-year Treasury yield hit a high of 2.26% this morning, up from the early February low of 1.68%, despite massive across-the-board economic data weakness, as validated by last week's uber-dovish FOMC statement, which in and of itself wouldn't be so worrisome if it weren't accompanied by falling stock prices and a plunging dollar index. And by the way, for all of those of you who said that gold is falling because the dollar is rising, please tell me why gold is not going up now that the dollar is plunging. Anyhow, frankly, I can't recall a time when stock and bond prices simultaneously declined, let alone given today's maniacal government support of equities via the President's Working Group on Financial Markets and bonds via the Federal Reserve. This morning, these immoral, illegal manipulation operatives were able to turn the tides on what was shaping up to be potentially a very scary day of financial market losses. Whilst, of course, the gold cartel did what it does best in first using its DLITG, or don't let it turn green algorithms to prevent gold and silver from turning positive yesterday amidst at times crisis-like conditions. Second, deploying the ubiquitous 8 o'clock p.m. Eastern Standard Time algo last night when all the world's asleep to deflate budding precious metal enthusiasm. Third, administering the 432nd 2:15 a.m. Eastern Standard Time raid at the opening of the London pre-market paper trading session of the past 494 trading days when gold again threatened to rise, and finally, viciously attacking at the COMEX Open as apparently the only economic data gold is allowed to respond to significantly are rigged jobless claims report that come in slightly better than expected, even when published simultaneously with the aforementioned largest challenger job cut report surge in 4 years, as well as a decline in the U.S. population to employment ratio. That said, I have the feeling today's manipulative respite won't last long, as what we are seeing in the massively deformed, highly volatile, increasingly unstable financial markets is starting to mirror the equally treacherous economic environment worldwide. Whether the bond selling is due to Chinese selling, hyperinflation fears, or something equally terrifying, the fact remains that such movements are not only significantly outside the power that be's manipulative playbook, but horrifyingly threatening to an historic dead edifice standing solely on the supposed confidence of strong stock markets and record low interest rates. And thus, if either of these asset classes start to waver, let alone crash, as their historically high valuations dictate they inevitably must, the endgame we all know is coming will be upon us before you can blink. Not to mention before you have a chance to protect yourself, both financially via the time-honored wealth protection of physical gold and silver, and otherwise. To that end, if you are considering the purchase or storage of precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached at ahoffman@milesfranklin.com. Thanks very much.